Hey there, everybody. My name is Bart Baasens, and together with a colleague professor of mine, Professor Christine Smets, who is also connected at the Faculty of Economics and Business here at KU Leuven, I would like to present to you a recent paper that we wrote together and that was accepted and already published in the British Accounting Review on how to boost contemporary credit risk models. And in fact, the article is based upon having done more than 2 decades of research, education, and consulting in the area. So throughout the article, we're actually giving various recommendations to boost credit risk models also from various types of perspectives, right? We're going to look at the data, we're going to look at the model, we're going to look at the various techniques that can be used to model credit risk, we're going to look at the evaluation thereof, we're going to look at the usage thereof, and we're also going to say a few words about things like stress testing, model risk, etc. In fact, here you can see the link to the article. So it has recently been accepted in the British Accounting Review. It's also publicly and for free available on the SSRN website. And I just checked before recording this presentation, it's currently the second most downloaded paper in the category Econometric Modeling Financial Markets. And if you want to have a copy of this paper, you can have it. I will put a link in the comment section below this video on YouTube or any other social media channel. First of all, some information about myself. So I'm Bart Baasens. I'm a professor of data science at KU Leuven. I'm also a part-time lecturer at the University of Southampton in the United Kingdom. And my research centers around data science. So we do a lot of technical innovation within my research team. That means that we focus on developing new algorithms, new ways of analyzing data, new ways of measuring the performance thereof, etc. But that we typically also connect that to a particular type of field within economics or business. And for me, that's typically credit risk, fraud, or marketing, more specifically customer lifetime value, or things like response modeling, retention modeling, customer segmentation, and so on. I also have a YouTube, Facebook, and Twitter account. It's called dataminingapps.com. You can connect to you can have a look at the website. There you can register for our 2 weekly newsletter, which features some of the recent research we have been doing on analytics, which features some interesting links to papers that we have read, articles that we have read, and so on. So I strongly encourage you to have a look at our website. It's all for free. It's nothing. We're academics. We're not in it for the money. We're in it for the science and for the research. I also have an online course platform, which is called bluecourses.com, where I offer various types of courses on machine learning, on credit risk modeling, fraud detection, deep learning, text analytics, etc. And it's an initiative that I launched about 3.5 years ago now. And part of our revenue, of the revenue we get from selling courses on this platform, is invested for sustainability purposes. More specifically, what we do is we pledge to invest 20% of our EBIT, earnings before interest and taxes, to companies cleaning up our precious oceans from plastic. The article was co-authored with a colleague professor of mine, Professor Christine Smets, who is a professor of finance here also at KU Leuven. Her research centers on asset management, risk management, and retail investors. And actually, during the writing of this paper, it was nice to see how both of our skills, how both of our experiences, both research-wise, education-wise, and consulting-wise, nicely complemented and resulted in what we believe and hope is a very nice article. Okay, so here you can see the overview of my presentation. You see that there's a lot of ground we will cover. First, we're going to start with a brief introduction and why credit risk modeling is so important nowadays. Then I'm going to zoom into the credit risk model architecture. I'm going to discuss various types of credit risk model requirements and the trade-offs between each of them. We're going to elaborate on how you can boost credit risk models in terms of leveraging new data sources, in terms of doing clever feature engineering. We're going to talk about Bayesian learning, about deep learning, profit-driven modeling, using models, how you can and should use models, credit risk models, not only for risk purposes, but also integrate them with the revenue generating business lines, etc. We're going to say a few words about stress testing and also elaborate quite extensively on model risk. That's one of the topics that fascinates me a lot these days, especially with the emergence of LLMs, large language models like ChatGPT, etc., which offer various types of opportunities for credit risk modeling, but also obviously come with a certain amount of threats that should be nicely qualified, but also quantified. And then we're gonna conclude this presentation with some suggestions for future research. Okay, let's start with the introduction. Well, following the financial crisis of 2008, when many lenders, financial institutions, insurance companies that provided credit products went bankrupt, the importance of risk management increased. And that resulted also in better types of risk management. So everybody tried to make sure that we learned some lessons from the crisis and try to see how we can move forward in order to make sure that a crisis like the one we had in 2008 was never going to occur again. Unfortunately, if you look at modern day trends, you will see that the year-to-date defaults, according to Standard & Poor's, a report they published recently in this year, 2023, the year-to-date defaults is the highest since 2009. A similar observation is made by the Swiss reinsurance company, abbreviated as Swiss Re, which is a reinsurance company based in Zurich, Switzerland, and is one of the biggest in the world. And they note that the rate of default will increase even up to 15% for high yield instruments in case of a severe recession. Both these observations are basically also corroborated by the European Banking Authority in a report they published in 2022, and in which they noted that there were more loans with higher credit risk. On top of that, due to restrained access to bank credit, we also witness a boom in private credit, which, coupled with less transparency and weaker regulation, could also hide additional credit risk, right? And all this credit risk, once that comes together, it can reinforce one another, create a snowball effect, and also, as such, create quite a big amount of systemic risk. So we better make sure that we keep on having a close eye on our credit risk models and make sure that they're up to date, high performing, and leveraging all the potential data they can in order to measure risk as good as possible. Now, a modern day credit risk model actually has three types of inputs. First of all, the probability of default, abbreviated as the PD. It's a probability, so it's a number between 0 and 1, and it usually measures default during an upcoming 1-year time period, according to regulations such as Basel, IFRS 9, etc. It obviously would be nice to also have risk measurements which extend beyond that 1-year time horizon. That's something we're going to come back to later on throughout this presentation. The probability of default is a number between 0 and 1. The loss given default is also a number between 0 and 1, but it's not interpreted as a probability, it's more interpreted as the percentage. A percentage of the exposure, the outstanding exposure, which is the EAD, the outstanding exposure, which is lost in terms of default. So if an account would go into default, how much are we expecting to lose from the outstanding amount? Expressed in terms of a percentage, this is the LGD, loss given default. Exposure at default is then the outstanding amount. And for on-balance sheet items like installment loans, like mortgages, like car loans, student loans, and so on, this is pretty easy to determine because you just look at the outstanding amount. But for off-balance sheet items, think about home equity lines of credit in the United States, think about credit cards, think about credit lines. Exposure at default is a lot more difficult to determine. So there's various modeling challenges that come about there, which we also extensively discussed in our courses, in some of our previous research, in some of my books. You can see one of my books, but this is actually the first book I wrote together with Tony Van Gestel on credit risk management, where we extensively elaborate on each of these three parameters and how they can be jointly combined in order to calculate the economic capital according to Basel. Okay, what are modern day challenges then? Well, a first challenge is that we need to estimate PD, LGD, and EAD as good as possible. And there's various challenges or sub-challenges, or you can disentangle these challenges into various subtopics, like we should make sure that we leverage as much as possible of the data available. And obviously, with the heavy digital footprint that many of us are leaving behind nowadays on social media, on the internet, or as soon as we connect with our iPhone, etc., all of that data offers some very nice potential for credit risk modeling. And we're going to elaborate on that as well when we talk about new types of data sources. But it's not only about the data, it's also about what you're going to do with it. How are you going to transform the data in a clever, smart way to your benefit? How are you going to do clever feature engineering to make sure that the data is leveraged to its fullest extent? Feature engineering is one of the topics that we will extensively elaborate on as we move further. But then, looking at new data, doing good feature engineering, then we also have the modeling part. New types of modeling techniques. Does deep learning have anything to offer for us in credit risk modeling? Yes or no? That's something that we will discuss later on. Are there new ways that we can measure model performance? Is it merely statistically based in terms of area under the ROC curve, R squared, Pearson correlation, students t-test, Brier score, etc.? Or is there an alternative perspective? You can see that I'm clearly hinting at an alternative perspective here. And one of those alternative perspectives that I will discuss is profitability, for example, and also interpretability, ecological footprint, operational efficiency, and so on. And then obviously what's also very important is that we start using these models in a more clever, integrated, cross-firm, cross-company way. So here we're talking about the aggregation of PD, LGD, and EAD at portfolio level. That could be country portfolio, industry portfolio. So aggregating all these three key measures is a very important challenge. Why? Because there are very complex intricacies when it comes to the interaction between them, right? PD and LGD and ED, there's some correlation effects between them that clearly play, and that should be factored in as we start aggregating this at portfolio level. All of this comes with two types of risks: overcapitalization and undercapitalization. Overcapitalization means that you have too much capital set aside. You're too well protected. So obviously, this is very costly with, at the individual bank level, a lower return on equity, and thus the accompanying risk of being competed out of the market, right? Something you don't want. That's in case of overcapitalization. In case of undercapitalization, on the other hand, you have an increased risk of bank failure, as such jeopardizing bank continuity. And you know, in the financial system, if one bank goes down, it could also result in another bank going down, in a knock-on effect, as such creating a serious type of systemic risk. So in this paper, we try to fill two research gaps. First of all, we try to give a concise, condensed, yet well-focused literature overview of the state-of-the-art in credit risk modeling. And doing so was quite a challenge for us because publications on credit risk were spread out across different disciplines, as I did with my research. It's spread out across accounting, finance and banking, to analytics, machine learning, operations research, and even research on legislation and ethics. So that was kind of a challenge that we faced when we started doing this literature overview. Another important gap that we try to fill with this overview paper is that we try to give clear recommendations about how to boost credit risk models. And we sincerely hope that our recommendations will help catalyze future research in credit risk, which is, first of all, which I think is very interesting, but which also has a very big societal impact, if you ask me. It can give better access to credit markets, even for people about whom we have no information. Think about people in developing countries. Think about people that have people for whom we don't have a lot of data available, like newcomers to credit markets and so on. So it's also about widening the access to credit markets. That's also a very important thing to pursue as we start to perfect our future research in credit risk modeling. If you look at contemporary credit risk models, and that's a figure that I've been using, I don't know, about 20 years right now throughout many of my courses and presentations I did on credit risk modeling, we typically have three levels. Level 0 is the data. That could be internal data or external data. External data could be data relating to the macroeconomy, gross domestic product, GDP, inflation, unemployment, etc. Internal data could be transactional data, could be socio-demographic data portraying your customer, could be facility data of the type of credit facility, like is there collateral, what type of collateral, how much, what is the loan to value ratio, etc. So you have all these various types of sources that are then being fed to level one, where you build a model that discriminates. And in terms of PD, probability of default, we try to come up with a scoring model. Scoring model that assigns high scores to the good payers, low scores to the bad payers. And in terms of PD modeling, we kind of have two types of scoring techniques or scoring models. That's application scoring, which is credit scoring at loan origination to decide whether you're going to accept the credit, yes or no. And we also have behavioral credit scoring. Behavioral credit scoring is once the customer has entered your portfolio, um, you also want to continuously monitor their credit worthiness. And you typically do that by closely inspecting and quantifying their recent behavior, typically about a year ago, and then project that into a credit risk measure, into a score for the future. So for PD, we have application behavioral scorecards, scoring models. Usually both of them are built using logistic regression, right, which is a standard statistical classification technique that has been with us already for many years right now. And rather frustratingly, we see that even nowadays, despite that logistic regression technique already having aged quite well, it's still very popular. It's still being used a lot for credit risk modeling because it performs really good, even when compared to modern day techniques like extreme gradient boosting, like deep learning, etc. Um, One final note about application behavioral scoring. Usually application scoring models have about 10 to 15 variables, so do behavioral scoring models. Application scoring models usually behave a bit lower in terms of performance because behavioral scoring models have more up-to-date recent information available, so they typically perform better. Having AUC scores, I would say about 80 to 85% area under the ROC curve that stands for, whereas application scoring models somewhere between 75, 80% is typically the AUC range you find there. For LGD and EAD, and I kind of cover both of them in the same way because they're very similar from a modeling perspective, since EAD is typically measured for off-balance sheet instruments in terms of the credit conversion factor, which is also a number between 0 and 1, just as LGD is. Well, these models are typically estimated by means of linear regression techniques, two-stage models. Um, where one stage will decide whether a defaulted account will cure or not, and a second stage is then a typical linear regression model estimating the loss in case the account does not cure. So there we see that we have a little bit more diversity in terms of the techniques that are being used. We have linear regression, you have even logistic regression, but tailored a bit towards an LGD EED setting. You have two-stage models, you have regression trees, and so on. And the frustrating thing when you do LGD and EED modeling is that the performances that come out are usually very low, with R-squareds seldomly exceeding 20%. So there's a lot of margin for improvement when you do LGD and EED modeling. Then we have level 2, which is the ratings and the calibration. At level 2, we're going to define default ratings, ratings for PD modeling, and each of those ratings comes with a calibrated probability of default. Likewise for LGD and EED. So there we're going to come with calibrated ratings for LGD and EED. And then each of those ratings, for LGD we call them facility ratings, comes with a well-calibrated LGD and EAD estimate. And for LGD and EAD, there's an additional caveat that that should be catered there, and that's the fact that they should be economic downturn calibrations, right? Because the reason for that is, for those of you who are a little bit more familiar with the Merton or Vasicek model, which basically underlies um, the Basel Accords, is that basically what the Vasicek model does is it takes the PD together with the asset correlation and transforms that into a 99.9% worst case PD. Now, that Merton or Vasicek model is a structural model, and we do not have any equivalent of that for LGD or EAD. So that's why for LGD or EAD, the regulators kind of put the burden with the banks and said, you guys, you better come up with economic downturn LGDs and EADs in a way you deem appropriate. And we will then see whether that's fine, yes or no. At level 2, also various types of performance metrics. For PD, we have Breer scores, we have binomial tests, we have normal tests, we have even a Vasicek test. we have a Hosmer-Lemschau test. For LGD and EED, we look at students' t-test, non-parametric versions like Wilcoxon sign rank test, etc. So there's various performance measures right there, all nicely described in both of my books together with Daniel Rush and Harry Schuller. Daniel Rush from the University of Regensburg and Harry Schuller from University of Sydney. So in case you want more information. Okay, so if we look at modern day credit risk model requirements, we see that statistical accuracy, the one I listed at the top, is the most important. And statistical accuracy for PD, this is measured as area under the ROC curve or the Gini coefficient, also called accuracy ratio, which is linearly related since the accuracy ratio is 2 times the AUC minus 1. For statistical accuracy for PD, we look at Kolmogorov-Smirnov. We look at Breer score, which is an accuracy measure that is situated at level 2 of the credit risk model architecture. We look at the binomial test and so on. So you see that statistically, the statistical accuracy measures, there's a plethora of statistical accuracy measures for PD, LGD, and EAD that have been suggested in the literature. But there's more that is needed to turn a credit risk model into a good, well-performing model, because they should also be interpretable. Credit risk models should be interpretable, right? Usually, simple models are very interpretable, right? If we look at linear regression or logistic regression, those are very interpretable. And for those of you that are using logistic regression and want to take one step further in terms of interpretability, I can strongly, as a side remark, recommend the use of nomograms. Nomograms is like a visual, very nice representation of how a logistic regression actually functions and how the different types of predictors contribute to the prediction and in what way. So nomograms. If you have black box models, and black box models are usually not tolerated for credit risk, there you can look at Shapley values, Lime, counterfactuals, etc. So interpretability is also very important, and especially in a credit risk modeling context, because models should be validated by external regulators, hence they insist on them being interpretable, but also you're making very important decisions because you're giving somebody access or no access to the credit market. So if you're denying access to a credit market, the person that is being denied access is entitled, if you ask me, to a fair explanation thereof, hence the need for interpretability. Then we have regulatory compliance. And regulatory compliance, there have been various types of accords that have been published, like the Basel Accord, like also the guidelines IFRS 9, which kind of originated from an accounting discipline. And those put forward some very strict requirements in order for credit risk models to be regulatory compliant. But it's not only about the Basel and the IFRS 9 guidelines, it's also about privacy and ethics guidelines. As we will see later on when we're going to start talking about the different types of data sources that can be used to boost modern day credit risk models, you will see that many of the data sources come with, some privacy hazards, some ethics concerns, like can we use social media data, like Facebook data, like Twitter data, etc. Can I use your calling behavior, like can I see who you call and use for credit risk purposes, etc. So the regulatory compliance becomes very important because we have a tremendous amount of data sources that can be leveraged for credit risk modeling. So we need to keep a close eye to make sure that everything happens in a regulatory compliant way. Since deep learning models, and these are models sometimes with millions, billions of parameters, are also getting more popular, think about generative large language models like ChatGPT, etc. And given the fact that these models are typically estimated on very heavy hardware accelerators, that gives them a very big ecological footprint, right? A very big ecological footprint. An ecological footprint that is typically measured, for example, in terms of energy that is being consumed by a hardware machine in order to build the model, energy that is being consumed in terms of kilowatt hours, CO2 emissions in grams, or the equivalent of miles driven by a car. So the ecological footprint also becomes more and more important as we see these complex models being popping up more and more and offering various types of potential to analyze unstructured data, as we will discuss later on. And then we have profitability, because the question is, how do you measure the profitability of a credit risk model? That's not that easy as it may sound initially, because there's various things that you have to factor in: opportunity cost, marketing effects, and so on. So the profitability of a credit risk model is very interdisciplinary in nature, if you ask me. And later on, I'm going to report very briefly, because this is just an overview presentation, on some profitability research that we have done in order to make credit risk models more profitable, to measure their credit, the profitability, and to also build credit risk models in a very profit-focused way. And obviously, there's very unfortunately trade-offs between each of these requirements. Like, imagine that you would focus on deep learning. Deep learning is an area within machine learning that focuses on learning very complex patterns by using especially tailored neural networks, which have different types of layers of neurons that collaborate with each other in very complex ways, so as to capture more complexity out of the data, so as to squeeze the last amount of knowledge or patterns that are in there, and then leverage them for predictive purposes. But you can imagine that these deep learning models, being so complex, obviously will will result into models that are not very interpretable. So that's why we see, if deep learning models are being used, that they're being complemented with explanation facilities such as Shapley values, Lime, counterfactuals, and so on. So there you have this trade-off between very accurate, statistically accurate deep learning models, but not being interpretable. And you also have a trade-off because these deep learning models are being estimated on very advanced state-of-the-art hardware accelerators. It also gives them a heavy ecological footprint in terms of energy consumed in kilowatt hours, as I said earlier. So you typically see trade-offs between each of them. That's why you have to be very careful as you're starting to investigate the various ways to boost the performance of your credit risk model. In what follows, what we will do is we will actually look at four components: the data that feeds into the model itself, which is built using some kind of technique like logistic regression, like linear regression, like decision trees, and so on. We'll also inspect the evaluation thereof, and then also the deployment of the credit risk model. So once they start getting deployed in particular types of business settings. And for each of them, we're gonna discuss certain ways to boost your credit risk models. Like in data, in the data component, we're gonna look at new data sources. We're gonna see what are the types of new data sources that we can leverage for credit risk modeling. We're also gonna look at feature engineering. So how can we do very smart feature engineering to make sure that the features that we're gonna use for the modeling are as optimal as possible, to make sure that the modeling technique, be it a linear or logistic regression or a Bayesian learning method, can fully exploit that feature in its modeling task. In terms of modeling, we're going to look at Bayesian learning, which I think has a lot of potential. And I also, already in my PhD, I did some work on Bayesian networks, which I still think has a lot of potential to offer for modern day credit risk models. We're also going to look at deep learning, briefly say a few words about ChatGPT and how deep learning can actually contribute to better credit risk models by analyzing unstructured data. Modern day credit risk models are especially built using structured data like tabular data sets, like rows depicting loans and columns depicting predictors. But unstructured data like text documents, like loan descriptions, like social media posts, like pictures, etc., could also be very useful for credit risk modeling and leveraged by means of deep learning techniques. Then we're going to look at the evaluation of these models in a profit-driven way based upon our research. Much of this presentation, as I told you earlier, is based upon 2 decades, more than 2 decades of research and consulting we've done in the area. So we'll embed a lot of our own research in there. And then we're going to say a few words about deployment, more specifically by zooming into model use. We want to make sure that the model is consistently used throughout the entire firm. That's something we plead for. And then stress testing. And then at the top here of my slide, you can see that I will also say a few words about model risk based upon a recent book that I published together with a co-author, Professor Seppe van der Broek, on how to qualify model risk, how to define it first, and then how to quantify it as well. Something which is also of very much interest to the field of credit risk modeling. And you see that model risk is a kind of all-encompassing type of risk because it includes the data risk, it includes model risk, evaluation risk, deployment risk, and so on, as we will see later on. Let's first have a look at the new types of data sources. Well, when we talk about the new types of data sources, what's really very important is that we're going to actually mention some data sources which may seem controversial at first sight. So it's always very important that whatever data source you're considering is that you're also taking a close eye on any privacy regulation that may exist or any ethical guidelines that may be in place. So I'm just going to highlight the data sources, but obviously each of them should be considered um, against against the relevant legislation and guidelines. Also, uh, most of the research papers that we have studied or included in our literature survey only include one type of these data sources that we are about to mention. So it would be interesting, and that's one of the topics that I'm going to come back to later on, to see future research doing one, replicating some of the findings of these studies. That's very important because many of the data sources that I'm about to elaborate on are only based on one study, so replication would be really nice. And secondly, what also would be very nice is, I mean, when some of these data sources are combined, the joint effector of and any interactions that may exist. So combining these data sources could also be very interesting for credit risk modeling. Well, in terms of text data, which is unstructured data, we have structured and unstructured data. Remember, structured data is what you can represent in an Excel table with rows depicting loans or obligors, and in the columns depicting all kinds of predictors or features that we can use for credit risk modeling. The first type of text data is loan officers' text statements. That has been used in a previous study, and a loan officer text statement is essentially a textual loan assessment made by a credit officer, a loan officer, to mitigate limited data availability, which you may encounter, for example, in an SME context. And the paper that we cited in our work also studied how loan officer tax statements, how these textual data sources could be used for good credit risk modeling in an SME setting. Loan descriptions are also a textual type of data source, and they typically provide also a detailed textual representation of the loan and may include information like the borrower's background, debt status, loan purpose, and other types of aspects. SEC filings, and SEC stands for Securities and Exchange Commission. These are financial statements and other types of regulatory documents that public firms in the US should submit to the US Securities and Exchange Commission on a regular basis, providing information about a company's financial health and future outlook. Also, that has been analyzed in terms of its relevance for credit risk modeling. And it has been shown in the papers that we have cited in our paper that this turns out to be very predictive. Some researchers also used news reports, some researchers have, for example, constructed a global news sentiment indicator from the Thomson Reuters News Analytics database and found it to be very predictive for predicting credit default swaps CDS returns. So also news reports could be very interesting to consider for credit risk modeling. Then we have social media data. When I say social media, obviously we're thinking about Twitter, we're thinking about Facebook, we're thinking about LinkedIn, etc. Any type of social media. And in our paper, we report upon a paper that used aggregate Twitter opinion and showed that that could, for example, help predict changes in credit default swap spreads. Some colleagues of mine of the University of Antwerp used Facebook data for credit risk and found clear clusters of befriended defaulters and befriended non-defaulters. And quite surprisingly, they also found that defaulters and non-defaulters tend to like the same pages, the similar Facebook pages, which again highlights the potential of Facebook information also for credit risk modeling. Other researchers have identified personality traits of borrowers through their social media Twitter posts and then try to distill psychometric patterns from there and relate that to credit risk. Network data is also very nice, and at the bottom right you can see one of our papers that I published together with an ex-PhD student, Maria Oscarsdottir, and a colleague, Christian Bravo, and industry partner, Carlos Sarote, and my previous advisor, Professor Jan van Tienen. And there we collaborated with a South American firm that was not only granting credit cards, but also offered telco subscriptions. So what we could do is we could relate the behavior on the credit cards to the telco information we have. Telco information, which is basically summarized into a CDR graph, call detail record graph. CDR graph is actually a graph that tells who calls who, how many times. Like Bart calls Aunt Sophie calls Victor, Victor calls Hannelore calls Aunt Sophie, Victor calls Bart. So you have this network that you can then construct about who calls who. That's called detailed record data, usually stored into a log, like a textual representation thereof, which we can then transform into a network and then use these network constructions or use these network insights to relate that to credit risk. And we found that people tend to call those in their economic circle. We found that people tend to call those in their economic circle, which obviously offers all kinds of interesting opportunities for credit risk modeling because we can now look at this call detail record data at these call networks and help that to build better credit risk models. That may sound like a privacy hazard, or that may sound very intrusive from a privacy perspective at first sight. Nobody wants to disclose their call data to their bank, right? But what may sound as an initial privacy hazard could also offer a potential, right? Could offer a potential for financial inclusion. Think about emerging markets, think about developing countries, think about developing countries where customers or people do not have a lot of information available about their historical credit quality. So given that these banks operating in these developing countries do not store a lot of information or no information about their customers at all, the availability of call detail record data could actually facilitate credit access to those people about whom we know nothing, right? So as such, what may sound as a privacy intrusion at first sight could also be used for financial inclusion to make sure that we open up the credit markets and offer more credit to people based upon just using other sources of data. This not only applies to people living in developing countries, but also people accessing the credit markets for the first time, about whom we have no historical information available, minorities, etc. Network data could also be constructed based upon geographic ties, right? Who lives who, right? So for example, in Belgium, it is well known that if we do a geographical analysis, that in certain regions, you see more defaulters than in other regions. So geographic location can also reveal very interesting information in terms of default risk. Also, you can also use network data by linking companies that are working in similar sectors, for example. By linking them based upon their economic activity, you can build a network and then leverage that for credit risk modeling. My former PhD student, Maria Skorsdottir, together with a colleague of mine, Christian Bravo, has done some very exciting work on that, work which we also cite in the paper. We can also look at family ties, and when we say family ties, these are typically formed by means of marriages or parent-child relationships. We can also look at corporate ties, build networks based upon corporate ties, which are typically based upon co-ownership, employment, and transactional services. So these are different types of networks that you can construct, and as such, leverage as new data sources for improved credit risk modeling. And network analysis is something that, in all modesty, if I might say, that we're pretty strong at in our group because we used a lot of network analysis for churn prediction, for fraud detection, and also now for credit risk modeling. We can also look at online data, like email data, for example. There's like a paper of a colleague of mine, Jonathan Crook, who is a very well-known credit researcher. He's retired, but I think he's still working a bit at the University of Edinburgh, where he looked at email usage and psychometric variables for credit risk modeling. Obviously, information about the emails was disclosed in full transparency with the email senders and receivers. And the example features that they used in the paper that we cite in our paper is like the number of emails sent, number of emails received, the number of contacts, the type of contacts, and so on. So all of that provides very important and interesting new data for credit risk modeling. And then also, same guy, Jonathan Crook, University of Edinburgh, used web browsing data. In fact, he obtained data from a major UK online retailer and financial services provider. So it was an online firm, which meant that we have a lot of information gathered by means of web server log analysis or Google Analytics or page tagging, etc., about how borrowers accessed the website, accessed the website of that retailer. So they looked at in their paper at the number of website visits, the number of payment sessions, the number of devices used, and so on, and see whether that related to credit risk. very interesting study. Other types of data is like Google Street View. Right? There's a very nice paper by Hebrew et al., which is also cited in our paper, which portrays the demographic and economic makeup of neighborhoods using Google Street View. And they basically, in their paper, which is published in the Proceedings of the National Academy of Sciences, it's one of the journals which I hope to publish my work someday. They basically show how socioeconomic attributes such as income, race, education, and voting patterns can be inferred from the cars detected in Google Street View images using deep learning. Very interesting insights because they found that more foreign cars in a neighborhood implies a higher than average income. So in other words, they found that German and Japanese cars, Lexus in particular, are found in areas with high median household income, whereas American cars like Bukes, Oldsmobiles, and Dodges are associated with lower to median incomes. Hence, the importance thereof for credit risk modeling. A colleague and close friend of mine, Professor Christophe Nuas from the University of Southampton, studied LiDAR data. And LiDAR stands for light detection and ranging, or laser imaging detection and ranging. And it provides a kind of three-dimensional elevation maps of landscapes and is available as open source. So us researchers were very interested in that. And Christophe Mues, together with Christian Bravo and another colleague, Stevenson, they proposed the usage of deep learning because it is highly unstructured data to create embeddings. An embedding is like a feature, a numerical condensed representation of unstructured data, such that it can be easily used for geodemographic analysis. And they illustrate in their paper, it's a very nice paper, the significant performance of the approach that they suggest for predicting 7 English indices of deprivation, such as income, employment, education, health, crime barriers to housing and services, and living environment. All of that could obviously come in very handy when we talk about LGD modeling. The data that they gather through by means of LiDAR can also become very handy in terms of LGD modeling in order to better estimate, for example, the loan to value ratio based upon the three-dimensional elevation map of where the loan collateral is situated. Then we have Google Trends, and Google Trends gives us very nice information about searches for particular types of key terms, searches per time frame and per demography. So one of my favorite countries is Italy. If I want to look at how often has in Italy, the term unemployment being used during the past 24 hours or 1 week, I can just look that up through Google Trends. So, and if you would see that in Italy, for example, unemployment has been searched a lot in Google during the previous 1 week, then that may be an indication that unemployment is on the rise. In other words, Google Trends allows us to do nowcasting. It allows us to be a bit quicker in terms of seeing that unemployment is on the rise, that maybe even inflation is on the rise, than waiting for the official government reports to come out, right? So Google Trends can look at trends and searches and then extrapolate that to is unemployment on the rise because many people start looking for unemployment, start looking for jobs, start looking for terms like social security benefits and so on. So that's what Google Trends offers you. Also very useful if you want to do stress testing and anticipate bad economic circumstances. Also, data related to sustainability could be worthwhile to consider for credit risk modeling, especially for sovereign credit risk portfolios, right? Um, Here we're also especially talking about climate change that will undoubtedly have an impact on credit risk. It will have an impact on collateral values, as such on loan to value ratios, and as such on LGDs. Um, we also did some work on that. It's cited to the right there, together with Arsh Anand and Roseanne Van Pay. And we studied the significance of sustainability risk in predicting Moody's sovereign credit ratings. And using XGBoost, extreme gradient boosting, combined with Shapley values, which is like the standard way of interpreting complex methods, and Lime, we found a significant yet complex non-monotonic and country-specific relationship between sustainability and credit risk. If you want more information, definitely have a look at this paper. Asset correlation is a term which often pops up in the Basel Accord. It's being set to 15%, for example, for residential mortgages, 4% for qualifying revolving exposures. But the way those asset correlations have been determined is in a very unstructured, ad hoc, very undocumented way. And I think a lot of research should be conducted in terms of better specifying these asset correlations and make sure that we have a very good scientific foundation behind them, because nowadays this is very much lacking. This is not the case in a corporate setting where asset correlations can be also measured by looking at stock valuation, etc. But in retail portfolios like mortgages, qualifying revolving exposures, this is much more of an issue. Then we come at the target for PD, LGD, and EAD. So for PD, usually it's 90 days in payment arrears, measured over a 1 year time period. It can be 120 or 180 days, like in US, sometimes it's 120, 180 days. Also in the UK, there's some changes. But rather than predicting whether a customer will default, yes or not, using the 90 days as hard cutoff, why don't we predict the number of days in payment arrears as such? So why don't we predict whether a customer is going to be 0, 1, 2, 3, 4, 5, up to 90, 91, and so on days in payment arrears, right? That's a censored variable that we're predicting there. And there exists some very fancy techniques that have been used in the literature, but only very seldomly, like 2-bit regression, in order to predict that. So predict the number of days in payment arrears. Or alternatively, we could also predict when a customer is going to default. Not if, but when, using survival analysis. And you can see a paper which I cited at the bottom right there that was written by an ex-PhD student of mine, together with an ex-PhD student of mine and a colleague, together with Laura Dierik and a colleague, Gerda Klaskens, on using survival analysis, which is a very particular, specific type of statistical analysis in order to predict when events happen. And as the term suggests, it kind of originates from medicine, where you predict when patients are going to die, but here we use it to predict when customers are going to default. Same applies for LGD and ED. And LGD, in terms of target definition, there's lots of things that need further investigation, like what discount factor are we going to use to discount future costs and benefits? How are we going to factor in indirect costs? How are we going to exactly qualify an economic downturn scenario, and so on? For EAD, I mean, pretty similar to LGD also in terms of the target. The discount factor is not an issue there, but also the economic downturn scenario. Also, EADs should be calibrated using an economic downturn scenario assumption, and also that is something that needs some further research. That brings us to the next important data component, and that's feature engineering. And feature engineering means that we're going to craft very intelligent features, smart features, so as to improve either the accuracy or the interpretability of the analytical model of the credit risk model. And when you do feature engineering, you can look at structured data engineering. That means that you have structured data. That means data that can be represented in a tabular format, in an Excel format, rows depicting obligors, loans, columns depicting predictors, variables, etc. Feature engineering you can do in terms of the rows, but you can also do it in terms of the columns. In terms of the rows, plenty of research has been done, like especially when you're facing a low amount of defaulters. If you're facing a low amount of defaulters, like if only 1%, 2%, or 5% of your portfolio consists of defaulters, your analytical technique, like logistic regression, may have troubles finding the right pattern. So you may need to help it a bit, right? By increasing the importance of the defaulters. By increasing the importance of the defaulters, and the way we can do that is by replicating the defaulters. That's what we call oversampling. You replicate a defaulter a few times. Each defaulter you replicate a few times. You can also undersample the non-defaulters, assuming that the total data set is big enough and that you have a big enough sample of defaulters. You can undersample the non-defaulters as well. And there's also SMOOTIE, which stands for Synthetic Minority Oversampling Technique, which is going to create synthetic defaulters by combining existing defaulters. And what we see there, based upon research that I've done together with some colleagues, is that usually what we recommend or what we do in our research when we have a skewed data set, we do undersampling or smoothing. There's other techniques that have been presented in the literature, like ADASIN, like MWO, etc. Usually those techniques, there's sometimes there's some nice statistics behind it, but to cut to the chase, they usually don't add a lot of empirical performance or a lot of empirical value to the modeling. So I would not consider any of these other techniques. And for instance, or observation engineering, when we look at the rows, just consider undersampling or smooth. Where there's a lot of performance to be gained is in feature engineering by looking at the columns, right? By looking at the columns and trying to derive smart features that contribute to the performance of our credit risk models. And here you can see a picture of me when I was a lot younger. I was at the start of my career. It was at a conference. I think it was in New York. And one of my big mentors, who unfortunately is no longer with us, Professor Lynn Thomas, he's the reason why I came and worked at University of Southampton in the UK, and I'm still connected to that. But he taught me a lot about credit risk modeling. So he kind of introduced me to that field by the amazing amount of work he has been done. And when I talk about course classification, he was one of the first that introduced me to the problem of course classification. And course classification means that if you have a variable that has lots of different values, um, how are you going to condense it in only a few values? Think about industry sector. Industry sector is a variable that can have lots of different values. There are lots of different industry sectors. So you typically have to find ways to course classify it. In other words, what you do is you come from a very fine granular classification, and you want to course classify it into a few categories because that will make your analytical models more robust. And there exist techniques to do that, like chi-squared analysis. This is very close to my fourth bullet on high-dimensional categorical variables, decision trees, or nowadays there exist even techniques that are based upon deep learning. One of those techniques is cat to vec, one word, cat to vec, cat to the number, to vec, which actually comes from categories to vectors, to numerical representations thereof. That's the whole idea of course classification. One way we usually tackle this when we do credit risk modeling is using WOE, which stands for weights of evidence, which is a way of categorizing high cardinality or high dimensional categorical variable into a few categories and then representing it in a numerical way, which is monotonically related to credit risk. Ratios are also very important when you do feature engineering. A ratio has a numerator and a denominator. Sounds pretty straightforward, right? Ratios have been proven to be very useful for credit risk modeling, especially when we talk about liquidity ratios, solvency ratios, profitability ratios, and so on. There's a couple of caveats that typically come with these ratios, like what if the denominator becomes zero? Then you have a division by zero. So if you use a ratio, you always have to ask yourself, what if the denominator is zero? You have to do something. How am I going to tackle this? A positive ratio value, a positive ratio value can stem from two possible sources. It could stem from the fact that the numerator and denominator are both positive, but it can also be that because the numerator and the denominator are both negative, because that also gives you a positive ratio value. And that's the difficulty that you have with a positive ratio value, is that you don't know where it stems from. Does it stem from positive and positive numerator and denominator, or does it stem from positive numerator, from negative numerator, negative denominator, right? And that's clearly, there could be two different situations that you have to cater for in your credit risk model. Trend features are also very important. The trend and loan to value ratios, the trend in behavioral scores, the trend in employment. How are you going to summarize that and factor that into your credit risk model? You're going to look at absolute trends, are you going to look at relative trends, or are you going to summarize them using some kind of time series modeling technique like ARIMA, GARCH, etc. Variable transformations. We've got a lot of experience with methods like the Box-Cox transformation, but even more experience with the Johnson transformation, because that's a type of transformation that allows us to see whether a variable has like um, an exponentially increasing effect on credit risk, or whether it has a saturation effect, whether a variable's effect on credit risk increases exponentially and then smooths out. That's all things that you can perfectly model using Johnson transformation, and that we have extensively used in our previous research, for example, in the paper that you see listed there at the bottom right in the Journal of Credit Risk on linear and nonlinear credit scoring by combining logistic regression and support vector machines. As I said earlier on, there's various types of new data sources that we can leverage for credit risk modeling. There's like textual data sources. Um, think about loan descriptions, think about news data, think about social media data, think about network data, and so on. And often these unstructured data sources are then using deep learning techniques transformed into embeddings. And an embedding is a numerical representation of an unstructured data element. It's usually a black box numerical presentation. Think about it as a vector that summarizes um, a figure or a text document or a paragraph thereof, such that it can be offered to traditional analytical techniques for numerical analysis, right? Okay, so that's about the data part. So now we arrive at the modeling part. And in the modeling part, there's two things that I would like to mention. There's Bayesian learning and there's deep learning. And Bayesian learning was named after Sir Thomas Bayes, who was a famous English statistician. Well, actually, he was more into probability calculus, I would say. And the idea of Bayesian learning is to combine prior knowledge, which is usually expressed in terms of a prior distribution, statistical distribution, and combine that prior knowledge we have with patterns that we have learned from data. This is especially relevant when we have settings in which we are having a lack of data. Think about exposures to sovereigns. There aren't that many countries in the world. Think about exposures to banks. Think about new credit products. For each of those three different types of categories, we don't have a lot of data available. There's not a lot of analytical modeling that we can do. However, all the data we have available, we want to make sure to use it to its fullest extent. But on top of that, we combine that with prior knowledge, expressed in terms of a prior distribution. Same goes for low default portfolios, which are the default portfolios in which we only have a limited amount of defaulters available. And in case we only have a limited amount of defaulters available, obviously that seriously hampers the statistical modeling. So we're going to combine it with exposures to sovereign, we're going to combine it with prior knowledge expressed as a prior distribution and do some very nice Bayesian learning, which is going to combine prior knowledge with data patterns in order to come up with models. Throughout my PhD already in 2002, you can see that paper there, which I published with Michael Egmont Peterson and some others. I studied how you can learn Bayesian network classifiers for credit scoring using Markov chain Monte Carlo search. So basically, a Bayesian network is a probabilistic white box classifier in which we have nodes that could be data elements like features or predictors. And between the nodes, we have arrows depicting dependencies. And from a Bayesian network, you can clearly read the types of dependencies that play between the different types of nodes, and as such, learn very nice structures, learn very nice knowledge that can be then leveraged for credit risk modeling. Because a Bayesian network can be nicely visually represented as a network, we often refer to it as a probabilistic white box model. Deep learning, the key message of deep learning is that it's very powerful. It works very good for unstructured data, not tabular data, but textual data, image data, video data, audio data. But for structured data sets, it doesn't work very well. And it has a very big ecological footprint because its deep learning models are typically estimated using millions, if not billions, of parameters. We did benchmark it in an earlier paper. You can see here in eJOR, we had a couple of I think we had 8 application scoring data sets, and we contrasted classical credit risk modeling techniques like logistic regression with ensemble models like extreme gradient boosting and deep learning. The major result was that deep learning did not have anything to add. The most powerful technique was XGBoost, but we were also I was not surprised, but what it could be surprising is that logistic regression, good old-fashioned logistic regression, still performs very well for structured data modeling. However, where deep learning can really show its merits is on unstructured data. And here you can see many of the data sources that we already referred to before, like loan officer text statements, which have been used by BERT. BERT stands for bidirectional encoder representation from transformers. It's a kind of pre-trained deep learning method that is especially focused, targeted towards analyzing text. Transformers can also be used for analyzing loan description texts. Network data, like the networks that we talked about when we talked about CDR networks, when we talked about networks based on family ties, like marriages, parent-child relationships, or corporate types, like based upon co-ownership, employment, and transactional services. Well, these networks can be analyzed, as we also did in some of our research, using graph convolutional networks or graph autoencoders, which are two types of deep learning methods tailored towards analyzing graph data. Images are usually analyzed using convolutional neural networks. Like Google Street View images, LiDAR data can be used like convolutional deep learning neural networks. BERT can also be used for analyzing social media posts, which is again textual data. And then here you can see in my penultimate row, you can see that user-generated descriptions from loan applications can be analyzed using convolutional neural networks, recurrent neural networks, convolutional recurrent neural networks, etc. So this whole field of deep learning is basically exploding in terms of the techniques that it's offering. It's continuously on a daily basis, you almost see new deep learning techniques popping up. Well, many of these deep learning techniques, they may have some merit. It's very important that you're critically towards them. And my recommendation is only use them for unstructured data, because in a structured data setting, they don't have much to offer. But if you have unstructured data like text, like networks, like images, like LiDAR data, etc., or mixed frequency data, there you can use deep learning. Then I have to say a few words about generative large language models, LLMs, the most important one, or the most popular one, being ChatGPT. Large language models can be very interesting for providing you with coding assistance. I use it a lot when I do some Python coding, because I mean, I don't use Python a lot, but if I use it, um, that's one of the disadvantages of becoming a, a professor and a PhD supervisor, because you're supervising so many PhDs, you never get your hands dirty on the coding anymore, which is not a good thing. So, but when I need to, I use, for example, ChatGPT to give me Python coding assistance in developing credit risk models. These LLMs can also help you parse and analyze unstructured data. May help you uncover new data sources and generate insights in black box credit risk models as an alternative to Shapley values, Lime, etc. They can also be helpful to provide you with model documentation and stress testing. So I still remember, for example, when I wrote the paper and I asked for a particular stress scenario to occur. Let's see where I can find it in the paper. So, for example, when I prompted ChatGPT 3.5 on April the 13th, 2023, and asked it about what exactly happened during the credit crisis of 2008 to the GDP, inflation, unemployment, and house prices. Actually, what we got was quite an extensive answer in terms of percentage changes of the measures for the US and Europe, which was very nicely summarized in overall, the credit crisis of 2008 had a significant impact on the global economy, leading to a decrease in GDP, an increase in unemployment, a decline in housing prices, and low inflation rates. You can ask for more specifics if you Q&A, if you prompt it a bit further, you can ask for more specific insights. So for stress testing, can come in very handy. There are some voices that also state that in the future it could help you generate draft credit scores, ratings, and even offers. I'm a little bit more skeptical towards that, but yeah, who knows? We'll see. In terms of the evaluation of the model, there's profit-driven modeling that pops up as being very important. And in earlier research, which you can see cited to the left with Thomas Verbraak, Christian Bravo, and Richard Weber, we developed an expected maximum profit measure, um, a measure that helped us quantify the profit of a credit risk model. Not only the profit, but also the optimal threshold, the decision threshold above which loan applications should be accepted and below which loan applications should be declined. Actually, we first developed an EMP measure for churn, which is also one of the areas in which we're very active, and then tailored that towards credit risk in the paper, which you see cited at the bottom left. And once we had very nicely formulated that EMP measure, we can start using it. We can start using it for doing model evaluation, as opposed to using, for example, as opposed to using area under the ROC curve, Gini index, and so on, we can now also quantify the EMP of a credit risk model. Note, and here we're focusing on PD, obviously. We can also use the EMP measure for doing model selection to help us tune a hyperparameter, like particular hyperparameter, like the number of features in a logistic regression model, the regularization term that you're using in your regression model if you're doing L2 regularization, but also the number of features that you want in your credit risk model. We now no longer have to rely on merely statistical measures like a p-value, but we can now see what feature contributes the most profit to my model and start selecting features in a profit-driven way. And finally, if you want to go all the way, you could do model building in a profit-driven way. And basically what we did was in earlier research with Eugen Stripling, who was a former PhD student of mine, we developed an extension, a new type of logistic regression. You know, logistic regression is a standard classification technique, but the way the parameters, the weights or the beta coefficients are estimated is by maximizing a statistical likelihood function. At the end of the day, you're not that much interested in a statistical likelihood function, but you're interested in profit. So what we did was we came up with a logistic regression extension, which we call proflogit, where the parameters are determined in such a way that they do not optimize the log likelihood, but that they optimize the profit instead. So we introduced a new type of uh, profit-driven logistic regression, which can be used for, we initially introduced it in customer churn, but it can also be used for credit risk modeling, right? The way we optimize the parameters there is not using a classical gradient descent because the mathematics didn't work out very nicely, but we had to resort, FYI, to genetic algorithms there. And then another PhD student of mine, Sebastian Huttner, built upon that research because number two most popular credit risk modeling technique is decision trees. And along the same lines, using genetic algorithms again, we developed a decision tree algorithm which we labeled ProfTree, as it makes splits in a profit-driven way. So rather than optimizing impurity and looking at entropy, chaos, Gini, etc., we choose the splits of our decision tree in a profit-driven way. So now we have extensions ready, proflogit and prof3, extensions of logistic regression and decision trees that directly optimize profit, which is very neat to also be used in credit risk modeling. Brings us to the deployment, and here the model use comes in as very important. That pretty much relates to the use test in Basel. The use test in Basel says that it's important that credit risk models are being used consistently and pretty comprehensively throughout the entire firm. So not only for credit risk modeling, but also in the revenue generating business lines, right? So it's very important that credit risk models are being used for pricing, for also for provisioning, calculating expected loss, for regulatory or economic capital calculation, for making credit approval decisions. And remember, um, based upon some of our earlier research, credit approval decisions can now also be made in a profit-driven way because in our earlier research, we made an extension we add as an add-on to our profit measure, we also came up with a profit-driven cutoff, which can then be used for credit approval decisions. But the credit risk models can also help you do proactive debt collection, right? Which is very important in an LGD setting to make sure that you try to mitigate your losses. As soon as an account goes into default, you can start seeing what type of actions to do in order to make sure that you mitigate the losses, right? So the credit risk models that have been built can come in handy for proactive debt collection. And a very interesting set of techniques to be considered there is Markov decision processes, which are very closely related to reinforcement learning to help you make decisions about what to do during what status of the collection process. It's very important that these credit risk models are also integrated with the revenue generating business lines, but also with other types of risk like market risk, operational risk, and liquidity risk, but it's because it's all interconnected. It's all one type of all-encompassing risk that a bank is facing. But obviously, factoring in these dependencies, these connections is very hard. And there have been some attempts made in the literature using copulas, for example, that allow you to couple different types of distributions into one comprehensive one. But obviously, this is all very challenging. But that's what makes it exciting to do research on, right? Stress testing is a kind of look ahead crisis prevention tool to identify vulnerabilities and see how resilient banks are to shocks in their environment, to shocks in the banking system, to shocks in the macroeconomy, to macroeconomic recessions, to GDP contraction, and so on. So basically, you want to make sure that a bank is always prepared for the worst. But the key challenge there is what is the worst, right? And that's something that regulators are continuously working on devising new types of stress scenarios and seeing how resilient banks are against them. These stress test results should obviously also be disclosed to the market to make sure that there's full transparency and which will increase the market discipline and make sure that investors can always make the right decisions. And in other words, the stress testing, what they do is they complement traditional backward-looking risk quantification methods and see how these can be extrapolated into a very dangerous, uncertain future where stress scenarios may happen, where recessions may happen, where macroeconomic downturns may happen. And the two most commonly used ways of doing stress testing are sensitivity analysis, where you either see if one variable changes how it affects your exposure, your risk exposure, which is what we call a single factor sensitivity stress test, or where you look at multi-factor sensitivity stress tests, where multiple factors are manipulated together, taking into account the mutual correlation and seeing how that affects the risk exposure or scenario analysis. And in scenario analysis, we can think of historical or hypothetical scenarios. Historical scenarios are where we look at what happened in the past and try to reenact that. And remember, ChatGPT can come in very handy in seeing what happened during a particular type of crisis that we experienced in the past. And then through simulations, we try to see if the scenario was to reoccur, are we well protected against it, yes or no? But given that the future never precisely resembles the past, hypothetical stress scenarios have also been considered as very important, um, taking into account various types of new risks that have originated. When we talk about new risks, we're talking about pandemics that may arise. Think about the COVID-19 pandemic and how it affected the worldwide economy. Think about all the dangers of the crypto markets, the cryptocurrencies, and how they create a lot of uncertainty, how they create a lot of risk exposures as well that should be factored in. Think about climate risk. Think about flooding risk, for example, its effect on collateral values, its effect on loan to value ratios, on LGD, etc. Think about the interconnectedness of the financial world, which is sometimes hard to understand. It's hard to first see it, to find it, to qualify it, but then it's also hard to see if to find the weak spots in there. And yet, this is something that we should aim for if we do stress testing. Think about the strong geopolitical tensions right now. Think about inflation shocks and so on. All of these are key challenges, together with the fact that when you're doing stress testing, you always, if, in fact, you want to forecast very far in the future. And it's well known that the further you go in the future, the bigger your confidence bands become because there's more uncertainty about the future. So that's very important to consider as well. Last topic is model risk. And remember, model risk was a kind of all-encompassing risk because it encompassed data, model, deployment, etc. And the interest in model risk got triggered by a FICO 2021 report. FICO stands for Fair Isaac Corporation. It's a company that is situated, I think, in San Rafael in California. And I used to teach for them a long time ago. And in a report in 2021, they found that 65% of the companies cannot explain artificial intelligence model decisions or predictions. That's a lot. Knowing that AI model decisions or predictions are more and more steering critical business decisions and the strategies, but also vulnerabilities of the firm, I mean, that's too much. That's something that we should work on. 73% struggle to get executive support for AI ethics, a very important issue, AI ethics, especially with think about all different types of data sources that we are about um, to leverage for credit risk modeling. So the ethics questions also with large language models like ChatGPT, there's more and more ethics questions that arise. Only 20% of the companies do model monitoring or model backtesting, which is not good, and 30% of the organizations report an increase in the adversarial and other attacks against models. Once you start exposing models in a public way on the internet, for example, There's various ways of doing what we call model backdooring. Make sure you get the model to do what you want it to do. Model exfiltration, which means that you try to exfiltrate the model by asking it so many, um, by sending it so many queries that you can actually start to understand how the model works. These are all malicious attempts in order to manipulate the model and do really bad things that we should cater for. So model risk, we've written a book about it. You can see it at the bottom right there. It kind of states that all models are, it kind of got initiated, the book writing idea got initiated by means of the statement, all models are wrong, but some are useful, made by the famous George P. Box in 1976, a year after I was born. Box, also known for the box plot, right, which is often used to detect outliers in credit risk. We define it in our book as the risk of expected or unexpected loss resulting from the inadequate development or usage of analytical models across all business units and activities of the company. So we looked at a company-wide perspective when we try to frame the idea of model risk. Yeah. The thing with model risk is that you have to try to identify it and remedy it as much as possible. You will never be able to get rid of all types of model risk, but knowing that it is there can already be very helpful because even if you know you can't do anything about it in the first line, you may want to do something in a second line by using more conservative calibration, for example, of your PD/LGD estimates in order to compensate for certain parts of model risk that you cannot properly cater for. Here you can see some examples of model risk, um, which are spread out across different types of categories. I'm not going to go through them. They're also not elaborated on further in the paper, but each of those types of model risk, I mean, I have some references in the paper, is a research topic on its own. Like reject inference in PD modeling is a very important research topic where you don't have a lot of, where you have no information on your previous rejects. And yet you have to factor them in because they represent your future through the door population. So you have to factor them in a certain way as you develop your new credit risk models. But how are you going to do that? And there's a lot of um, um, risk that comes with it. That's data risk. Specification risk, multicollinearity. Sometimes you can never get rid of um, all multicollinearity in the models. You will always have a certain amount of multicollinearity. How are you going to factor that in? And what's the maximum amount of multicollinearity that you tolerate? Development risk, data leakage is something that we often see. And we saw, when I did my literature study for this paper, well, we did our literature study for this paper, we saw quite a lot of papers where we thought that there was some data leakage between train and test set. You could just not, where we kind of suspected it, right? We could not prove it, but we kind of suspect that means that you use your test set for making certain kind of model development decisions, which is not a good thing to do, which is not something you should do. Validation risk means that sometimes you can use wrong evaluation metrics. Think about using statistical evaluation metrics, where one should also look at profit-driven evaluation metrics or ecological footprint, etc. Operational risk means like data drift. Your data is continuously changing, output is changing. Model overrides means that domain experts are going to override a model's decision. It's something you don't want to happen. So how are you going to cater for that? Security risk, fraud. When I do a credit application and I provide fraudulent information, that should be detected. Model exfiltration, by repeatedly querying a public model, I may try to train my own model, which comes pretty close to the original one, such that I can behave it in the way I want it to behave. Model backdooring is that means that you um, found leaks in the model that allow you to do what you wanted to do. Managerial risk is also a very important source of model risk. How are you going to smoothly transition to a Basel IRB approach? What about Basel versus IFRS 9? Sometimes there are some minor discrepancies there that should be catered for, and model governance. All of that I have some references for in the paper in case you are interested. So the suggestions for further research, here you can see them. Data, try new data sources for credit risk modeling. I think even replicating some of the studies that we highlighted could already be very interesting. And then combining some of the data sources, like combining text with images, combining text and images, and maybe some other information we have upon our data, upon our customers, etc. Feature engineering, we looked at instance feature in instance engineering, where we said like undersampling and smoothie are fine, but in the real feature engineering, in coming up with very clever features that help us boost the performance of our credit risk models, I think that's very important for future research. The modeling side, I think Bayesian networks should be much more leveraged for credit risk modeling, much more explored, investigated, extended, tailored towards credit risk modeling, not only for PD, but also for LGD and ED. Deep learning and large language models and ChatGPT should all be embraced. We should not be afraid of it, but embrace it for credit risk modeling and see what we can do with that. We need profit-driven evaluation. In the research we did, we focused on PD, but that also applies to LGD and EED. So coming up with profit-driven measures for LGD and EED is also a very interesting avenue for future research, and then embedding them in the models is also very nice. Last but not least, deployments, more research about how the models can be consistently used throughout the entire, throughout all business lines, about stress testing, coming up with long-term solid stress scenarios is also very important. And then model risk as an all-encompassing suggestion for further research. I think more research is needed to appropriately identify, qualify model risk, hopefully also quantify it, and then counter it using the appropriate mechanisms. So you see, that more or less concludes my entire presentation with some very exciting suggestions for future research, some of which we're going to work on ourselves as well. But hopefully some of you that listened to this video and made it up till here, because I can realize that this is a very long video, hopefully some of you will join me on this exciting journey and work on some of these topics as well. Brings me to the end of my talk. Here you can see the overview slide again. We started from an introduction, then discussed the credit risk model architecture and the model requirements like statistical accuracy, interpretability, um, um, ecological footprint, um, regulatory compliance, profitability. We looked at how you can boost credit risk models by leveraging new data sources, by doing better feature engineering. And we looked at the modeling itself, discussed Bayesian learning, deep learning, discussed profit-driven modeling, profit-driven measure, which can be used for model evaluation, selection, or building, model use, stress testing, model risk, and ended up with some very exciting conclusions for future research. Thank you very much for those of you that made it up to here. Wow, that's really nice. You must be really very hardened. So, but thank you very much. If you want more information, this is the paper. You can download it for free at the bottom. As I said, it's currently ranked number 2 at SSRN in econometric modeling financial markets. Or you can have a look at my online learning platform where I have a basic and an advanced credit risk modeling course, which you can see right there. Each of them is about 6 hours of video lectures. It's online, it's self-paced. It features various types of quizzes. And once you finish both the courses, you also can get a LinkedIn certificate. Part of the revenue, like 20%, we pledge to investing in companies that clean up the oceans from plastic. So we're also aiming for sustainability. And then but I also have other courses on machine learning essentials, fraud analytics, social network analytics, text analytics, even deep learning is on the platform, etc. Thank you very much and hope to see you or hear from you in the future. If you like this presentation, it would be great if you can send me some feedback in the comment section or just give me a like. Thank you very much.